Advanced Audit and Assurance, Chapter 9, Evaluation and Review. Contents: 1. The review stage of the audit. 2. Opening balances and prior period comparatives, ISAs 510 and 710. 3. Subsequent events, ISA 560. 4. Going concern, ISA 570. 5. Chapter Review. Introduction. Competencies. Evaluation of accounting treatment. Analyze and evaluate, drawing conclusions on the appropriateness of stated accounting treatment in the context of a given business and a given scenario in the public or private sector in an audit assignment based on international standards on auditing and IFRS. Drawing conclusions and reporting. A. Analyze, evaluate, and propose how issues identified during the course of an audit or assurance assignment may be raised and dealt with in communication with management, directors, and those charged with governance, including action taken when issues cannot be agreed. B. Identify, apply, and explain procedures that may be used and considerations relating to the identification of subsequent events that may require adjustment or disclosure. C. Identify, apply, and explain procedures that may be used and considerations relating to the identification of risk issues that may require disclosure. D. Evaluate and apply quantitative and qualitative judgments based on the results of tests and evidence obtained. E. Draw conclusions and advise on the capability to report on an assurance engagement or audit engagement, including reporting findings, giving an external audit opinion, or dealing with other issues that may require inclusion in an audit report. Exam context. So far, students have largely focused on the planning and fieldwork stages of the audit. This section introduces the students in some depth to the completing phase of the audit, incorporating a number of new ISAs. By the end of this chapter, students will be able to describe the process and considerations for evaluating misstatements per ISA 450. 2. Audit opening balances and prior period comparatives in compliance with ISAs 510 and 710. 3. Explain how to audit subsequent events in accordance with ISA 560. 4. Summarize the concept of going concern and describe how to apply and comply with ISA 570. Subtopic 1. The review stage of the audit. Section Overview. 1. The need for a review. 2. Evaluation of misstatements, ISA 450. 3. Other areas for evaluation and review. Section 1.1. The need for a review. Having carried out tests of control and an appropriate amount of substantive testing, the auditor has reached the stage in the audit where he should carry out a review and an evaluation of the evidence he has gathered. 1. The auditor should back up his detailed testing of controls, transactions, and balances with a broader review of other information and events that may have an impact on the information presented in a financial statement. 2. Analytical procedures are also used at this review stage as a final check that the information contained in the draft financial statement makes sense. Section 1.2. Evaluation of misstatements, ISA 450. It is also at this stage of the audit that the auditor will make an overall evaluation of the level of errors he has found in the financial statement. Errors found in individual areas such as receivables or inventory will be summarized and totaled. The total amount of the errors will be compared with the materiality thresholds that were set at the planning stage. This will allow the auditor to reach a conclusion as to whether the financial statements are materially correct. One aspect of whether the financial statement shows a true and fair view. This area is covered by ISA 450, Evaluation of Misstatements Identified during the Audit. The objective of the auditor in this area per ISA 450 is to evaluate the effect of identified misstatements on the audit and any uncorrected misstatement in the financial statement. A misstatement could be in relation to the amount, classification, presentation, or disclosure of an item. ISA 450 requires the auditor to carry out the following procedures. 1. Accumulate all misstatements found during the audit unless they are clearly trivial. 2. If the total of misstatements identified during the audit approach or could approach materiality, decide if the overall audit strategy and audit plan need to be revised. 3. Communicate all misstatements found during the audit to an appropriate level of management and request that the misstatements be corrected. 4. If management refuses to correct the misstatement, obtain the reason for this and take those reasons into account when evaluating whether the financial statements as a whole are free from material misstatements. 5. Prior to evaluating the effect of uncorrected misstatements, reassess materiality per ISA 320. 6. Decide whether uncorrected misstatements are material individually or when added together. In making this assessment, the auditor should take into account the size, nature, and circumstances of the misstatement and the effects of any uncorrected misstatement from prior periods. 7. Communicate to those charged with governance the effects that uncorrected misstatements may have on the audit report. 8. Request a written representation from management as to whether they believe the effects of uncorrected misstatements are immaterial, individually or in total. 9. Documents. The amount below which misstatement will be regarded as clearly trivial. 2. All misstatements accumulated during the audit and whether they have been corrected. 3. Its conclusion as to whether uncorrected misstatements are material, individually or in total. Section 1.3. Other areas for evaluation and review. However, there are also a number of other specific areas which form part of the overall evaluation and review process, including the auditor's work on 1. Opening balances and comparative figures. 2. Other information published with the audited financial statements. 3. Subsequent events. 4. Going concern basis. Subtopic 2. Opening balances and prior period comparatives, ISAs 510 and 710. Section Overview. Section 1. Opening balances and comparatives. Section 2. ISA 510. Initial audit engagement, opening balances. Section 3. ISA 710. Comparative information, corresponding figures and comparative financial statements. Section 2.1. Opening balances and comparatives. The auditor's work on this area is regulated by ISA 510, Initial Audit Engagement, Opening Balances, and ISA 710, Comparative Information, corresponding figures, and comparative financial statements. In most countries, the financial statements of companies must include comparative figures for the previous year. To reach the conclusion that the financial statement presents a true and fair view, the auditor therefore needs to be confident that 1. Opening balances brought forward in the accounting records agree with the audited figures reported in the prior year financial statements. 2. Accounting policies have been applied consistently over the current financial year and prior years. 3. There is consistency of classification and disclosure between the current financial year and prior years. Where the current auditor performed the audit in the previous year and issued an unmodified opinion, it should be a straightforward exercise for the auditor to confirm that points listed above have all been complied with. A different situation arises when an audit firm is carrying out an audit of a client for the first time. For example, an auditor may be appointed to carry out his first audit of a financial statement for the year to 31st December 20x4. To do this, the auditor cannot ignore the opening statement of financial position as at 31st December 20x3. 1. The figures in the closing statement of financial position for the previous period will be presented as prior period comparative figures in the 20x4 financial statement. The new auditor is therefore given an audit opinion on published financial statements that include the previous year's closing balances. 2. Errors in the opening balances may affect the figures for the current financial period. For example, if opening inventory is misstated and is overvalued, the cost of sales in the current period may also be misstated, that is, too high. Section 2.2 ISA 510 Initial Audit Engagement Opening Balances. ISA 510 provides guidance on the auditor's responsibilities in relation to opening balances where 1. The financial statements for the prior period were not audited, or 2. The financial statements for the prior period were audited by another auditor, referred to as the predecessor auditor. The objective of the auditor when considering such an initial audit engagement is to obtain sufficient appropriate audit evidence about whether 1. The opening balances contain misstatements that materially affect the current period's financial statement, and 2. Appropriate accounting policies reflected in the opening balances have been consistently applied in the current period, or a change of accounting policies has been properly accounted for and disclosed. The following audit procedures are required. 1. Read the most recent financial statement and audit report, if any, for information relevant to opening balances. 2. Check that the prior period's closing balances have been correctly brought forward. 3. Check that opening balances reflect appropriate accounting policies. 4. One or more of the following procedures. Where the prior period financial statements were audited, review the predecessor auditor's working paper to obtain evidence reopening balances. Consider whether audit procedures carried out in the current period provide evidence on some of the opening balances. For example, cash received from customers in the current period gives evidence of the existence of a receivable at the opening date. Carry out specific audit procedures to obtain evidence Opening balances. A review of the audit report on the financial statements for the previous period. 5. If evidence is found that opening balances could contain material misstatements affecting the current period's financial statement, perform appropriate additional procedures to assess the effect. And 6. If such misstatements do exist, communicate this to those charged with governance in accordance with ISA 450. 7. Check that the accounting policies reflected in the opening balances have been consistently applied in the current period, or a change of accounting policy has been properly accounted for and disclosed. Section 2.3 ISA 710 Comparative Information, Corresponding Figures and Comparative Financial Statements. ISA 710 Comparative Information, Corresponding Figures and Comparative Financial Statements also relates to a similar area of the audit work. It deals with audit work on corresponding amounts and other comparative information for the preceding financial reporting period. The considerations in ISA 710 apply to all external audit engagements, whereas ISA 510 focuses particularly on new audit engagements and opening balances, that is, comparative statements of financial position figures. Audit procedures carried out on comparative figures are significantly less than those carried out on the current year figures. They are normally limited to ensuring that comparative figures have been 1. Correctly reported as required by the applicable financial reporting framework, and 2. Appropriately classified. ISA 710 therefore requires the auditor to evaluate whether 1. The comparative information agrees with the previous period, or where appropriate has been restated, and 2. Accounting policies have been consistently applied in the two periods, or if there have been changes in accounting policies, whether those changes have been properly dealt with. In addition, he is required to 1. Perform appropriate additional procedures if he becomes aware of a possible material misstatement in the comparative information whilst performing the current period audit. 2. Obtain written representation which cover all periods referred to in his opinion. The task set by ISA 710 should not present any problems where the auditor also audited the client's financial statement in the previous financial period and issued an audit report on those financial statements stating that they show a true and fair view. If he did not audit the prior period financial statements, then he should also follow the guidance set out in ISA 510. The audit opinion should not normally refer to the corresponding figures unless particular circumstances apply. These circumstances are considered in a later chapter. Subtopic 3. Subsequent events, ISA 560. Section Overview. Section 1, ISA 10 and ISA 560. Section 2, Audit work to check compliance with ISA 10. Section 3, events occurring after the reporting period and up to the date of the audit report. Section 4, facts discovered after the date of the audit report and before the financial statements are issued. Section 5, facts discovered after the financial statements have been issued. Section 3.1, ISA 10 and IAS 10 and ISA 560. It is not possible to prepare financial statements that present a true and fair view by considering only those events and transactions that take place before the date at which the statement of financial position is prepared. Material events that occur after the reporting period should also be considered when preparing the financial statements for the year. Purpose of IAS 10. IAS 10, event after the reporting period, has two main objectives. 1. To specify when an entity should adjust its financial statement for events that occur after the reporting period, but before the financial statements are authorized for issue. And 2. To specify the disclosures that should be given about events that have occurred after the reporting period, but before the financial statements were authorized for issue. Events after the reporting period are defined in IAS 10 as those events, favorable and unfavorable, that occur between the end of the reporting period and the date when the financial statements are authorized for issue. There are two types of events after the reporting period. 1. Adjusting events. These are events that provide evidence of conditions that already existed at the end of the reporting period. 2. Non-adjusting events. These are events that have occurred due to conditions arising after the reporting period. Accounting for adjusting events after the reporting period. IAS 10 states that if an entity obtains information about an adjusting event after the reporting period, it should update the financial statement to allow for this new information. An entity shall adjust the amount recognized in its financial statement to reflect adjusting events after the reporting period. IAS 10 gives the following examples of adjusting events. 1. The settlement after the reporting period of a court case, confirming that the entity had a present obligation as at the end of the reporting period as a consequence of the case. 2. The receipt of information after the reporting period indicating that an asset was impaired at the end of the reporting period. 3. The determination after the reporting period of the purchase cost of an asset, where the asset had already been purchased at the end of the reporting period, but the purchase price had not been finally agreed or decided. 4. The discovery of fraud or error showing that the financial statements are incorrect. Disclosures for non-adjusting events after the reporting period. Non-adjusting events after the reporting period are treated differently. A non-adjusting event relates to conditions that did not exist at the end of the reporting period. Therefore, the financial statement must not be updated to include the effect of the event. IAS 10 states quite firmly, an entity shall not adjust the amount recognized in its financial statement to reflect non-adjusting events after the reporting period. However, IAS 10 goes on to say that if a non-adjusting event is material, a failure by the entity to provide a disclosure about it could influence the economic decisions taken by users of the financial statement. For material non-adjusting events, IAS 10 therefore requires disclosure of the nature of the event and an estimate of its financial effect, or a statement that such an estimate cannot be made. This information should be disclosed in a note to the financial statement. IAS 10 gives the following examples of non-adjusting events. 1. A fall in value of an asset after the reporting period, such as a large fall in the market value of some investments owned by the entity between the end of the reporting period and the date of the financial statements are authorized for issue. 2. The acquisition or disposal of a major subsidiary. 3. The formal announcement of a plan to discontinue a major operation. 4. Announcing or commencing the implementation of a major restructuring. 5. The destruction of a major plant by a fire after the reporting period. The role of the auditor, ISA 560. The work of the external auditor in this area is covered by ISA 560, subsequent events. The objectives of the auditor per ISA 560 are to 1. Obtain sufficient, appropriate evidence about whether events occurring between the date of the financial statement and the date of the audit report are appropriately reflected in those financial statements, and 2. Respond appropriately to facts that became known to him after the date of the audit report that, had they been known to him at that date, may have caused him to amend his report. This means that audit procedures must be planned and performed so as to consider all significant transactions occurring after the reporting period. This means that the audit work does not stop with events only up to the end of the reporting period. There are 2 key dates after the reporting period: the date of the audit report and the date that the financial statements are issued. One, before the issue of the audit report, the auditor should actively look for significant subsequent events. 2. After the issue of the audit report and up to the time that the financial statements are issued, the auditor has to consider the impact of any significant subsequent events that come to his attention. However, he does not have to look for these events actively. Section 3.2. Audit work to check compliance with IAS 10. Audit work to check compliance with IAS 10 can be divided into 3 phases. 1. From the end of the reporting period to the date of the audit report. 2. From the date of audit report to the date that the financial statements are issued. 3. After the financial statements have been issued. Section 3.3. Events occurring after the reporting period and up to the date of the audit report. Between the end of the reporting period and the date of the audit report, the auditor is required to obtain sufficient appropriate evidence that all events that require adjustment of or disclosure in the financial statement have been identified and as suitably reported in the financial statement. Normal audit verification work. The auditor may find sufficient evidence of subsequent events in the course of normal audit verification work. Where this is the case, he is not required to perform additional audit procedures. Such normal audit verification work will include looking at sales, invoices, and cash transactions after the year end in order to verify items in the statement of financial position at the year end. For example, 1. The audit of receivables will consider whether receivables at the end of the reporting period are collectible. Cash receipts after the year end may indicate a significant non-payment, suggesting the need to write off a debt as bad. 2. The audit of inventory procedures includes A review of the net realizable value of inventory. Sales of inventory after the year end may indicate that some inventory in the statement of financial position is overvalued because subsequent events have shown that its net realizable value was less than cost. 3. A search for unrecorded liabilities may discover the existence of some unrecorded liabilities from invoices received after the reporting period but relating to the period covered by the financial statement. 4. A review of the entity's cash position at the end of the reporting period may find that a check from a customer recorded as part of the bank balances was dishonored after the reporting period. Procedures aimed specifically at identifying subsequent events. The auditor should also actively look for subsequent events up to the time that he prepares the audit report. Taking into account his risk assessment of this area, he should 1. Obtain an understanding of management procedure for identifying subsequent events. 2. Inquire of management as to whether any subsequent events have occurred which might affect the financial statement. 3. Read the entity's latest subsequent financial statement. 4. Read minutes of shareholders' meetings of the board of directors and senior management meetings held after the date of the financial statement and inquire about matters discussed at any such meetings where minutes are not yet available. 5. Obtain written representation in respect of subsequent events. Section 3.4. Facts discovered after the date of the audit report and before the financial statements are issued. Events after the date on which the audit report is signed. Even after the date on which the audit report is signed, the auditor retains some degree of responsibility for events of which he becomes aware. Up to the time that the financial statements are issued, he is not required during this period to actively look for subsequent events. His level of responsibility is therefore much reduced compared with the period before the signing of the audit report. If the auditor becomes aware of a fact that, had it been known to him at the date of the report, may have caused him to amend his report, then he must 1. Discuss the matter with management, 2. Determine whether the financial statement need amending, and 3. Inquire how management intend to address the matter in the financial statement. If the financial statements are amended, the auditor is required to carry out the necessary audit procedures on the amendment and extend his review of subsequent events up to the date of the new audit report. In some jurisdictions, management are not prevented from restricting their amendments to the effect of the subsequent events. In such cases, ISA 560 permits the auditor to restrict his extended review of subsequent events to that amendment only. In such a case, the auditor must draw attention to this restriction in an emphasis of matter paragraph or other matter paragraph. If management do not amend the financial statement for the subsequent event, but the auditor feels that an amendment should be made, the auditor should take the following actions. 1. If the audit report has not yet been provided to the entity, modify his opinion as appropriate. 2. If the audit report has been provided to the entity, instruct management not to issue the financial statement before necessary amendments have been made. If they do so, Take appropriate action to prevent reliance on the audit report after taking legal advice. Section 3.5. Facts discovered after the financial statements have been issued. As above, the auditor has no obligation to perform audit procedures or make inquiries regarding the financial statements after they have been issued. However, if he becomes aware of a fact that, had it been known to him at the date of his audit report, may have caused him to amend his report, then he should discuss the matter with management, determine how the financial statements need amending, and inquire how management intend to address the matter in the financial statement. If the financial statements are amended, the auditor is required to 1. Carry out the necessary audit procedures on the amendment. 2. Extend his review of subsequent events up to the date of the new audit report as above. 3. Review the steps taken by management to inform anyone who received the original financial statement and audit report of the situation. 4. Issue a new audit report containing an emphasis of matter paragraph or other matter paragraph covered in a later chapter. This should refer to a note in the revised financial statement that explains in more detail the reason for the reissue of the financial statement. As usual, in the real examination, you are likely to be asked to apply your knowledge to a given scenario. Example, subsequent events. You are the auditor in charge of the audit of hindsight, which has a 30 June year end. The subsequent events reviewed for the year ended 30 June year 5 revealed that on 1 August year 5, a receiver was appointed at a major customer. At 30 June year 5, that customer owed 200,000 naira and goods costing 300,000 naira made to that customer's specification were held in inventory. Both these amounts are material required. List the matters to which you would direct your attention in respect of the above in relation to the audit for the year ended 30 June year 5. If the audit report on the financial statement has not yet been written, 1. Check that the directors are willing to adjust the financial statement for this adjusting event after the reporting period. 2. Establish whether any cash has been received from this customer since the year end. 3. Review any correspondence from the receiver to establish to what extent the outstanding debt will be recovered. 4. Consider whether the goods held in inventory are now valued at the lower of cost and net realizable value, given that these goods were made to the customer's specification. This may depend on whether or not those goods can be sold to a different customer. 5. In the light of the above, consider whether any written downs proposed by the directors to receivables and or inventory are reasonable. 6. If they are not, or if the directors refuse to adjust the financial statement, consider the impact on the audit report. Note: if the event occurs after the date of the audit report but before the financial statements are issued, the auditor should discuss the matter with the directors of the client entity and ask what they propose to do. 1. If the directors intend to amend the financial statement to include or report the event, the auditor should rewrite the audit report accordingly and give a new date. 2. If the directors say that they do not intend to amend the financial statement, the auditor must consider the most appropriate course of action. If it is too late to rewrite the audit report, the auditor should consider communicating with the shareholders in another way, for example, by asking to speak at the annual general meeting of the entity, which is the auditor's right. In the longer term, the auditor should also consider resigning from the audit, but this would not be appropriate as an immediate response to the problem. The immediate requirement is to convey the auditor's opinion to the shareholders. Subtopic 4, Going Concern, ISA 570, Section Overview. Section 4.1, Introduction. The going concern assumption means that the income statement or statement of comprehensive income and statement of financial position are prepared on the assumption that the entity will continue in operational existence for the foreseeable future. If the entity is not a going concern, there will be a significant implications for the financial statement. For example, 1. The distinction between current and non-current for both assets and liabilities cease to have any meaning. All assets and liabilities become current. 2. All assets must be carried in the statement of financial position at their net realizable value. And 3. There may be additional liabilities. The auditor needs to be satisfied that the going concern assumption is appropriate to the financial statement under audit. This will involve an investigation of the financial and operating position of the client before the end of the reporting period. If this review indicates that the going concern assumption may not be appropriate, further investigation will be needed. Section 4.2, Going Concern, Duties of the Directors. In preparing the financial statement, the directors must satisfy themselves in accordance with IAS 1 that the going concern basis is appropriate. In some countries, there is a requirement for large companies, that is listed companies, to disclose the fact that, in the opinion of the directors, the company is a going concern. It is therefore the responsibility of management to make the going concern assessment. Section 4.3, Going Concern, Duties of the Auditor, ISA 570. The work of the external auditor on the going concern status of an entity is covered by ISA 570, Going Concern. Key points from ISA 570 are set out below. The objectives of the auditor in this area according to ISA 570 are to 1. Obtain sufficient appropriate evidence about the appropriateness of management's use of the going concern assumption in the preparation and presentation of the financial statement. 2. Conclude whether a material uncertainty exists that may cast significant doubt on the entity's ability to continue as a going concern. And 3. Determine the implications for the audit reports covered in a later chapter. There is a subjective area where judgment is usually required to assess the uncertainties surrounding the assumptions that were made by management in reaching their conclusion about the going concern status of the entity. ISA 570 requires that the auditor must perform risk assessment procedures to consider whether there are events or conditions that may cast significant doubt on the entity's ability to continue as a going concern. If management has already performed such an assessment, the auditor must discuss this assessment with management, determine whether the assessment identified any relevant events or conditions, and if so, determine management's plan to address them. If management has not yet performed such an assessment, the auditor must discuss with management the basis for the intended use of going concern assumption and inquire of them whether events or conditions exist that may cast significant doubt on the entity's ability to continue as a going concern. In evaluating management assessments, the auditor must consider the same time period. If management looked less than 12 months into the future, the auditor should ask management to make a reassessment looking at least 12 months into the future. The auditor must also inquire if management is aware of any relevant events or conditions beyond this time period.